Hi guys, today we will find out what the stock market and the bond market are. The stock market and the bond market are places where you can buy assets that will bring you profit. These assets are called shares or bonds. The difference between them is that shares are securities issued to the stock market by business owners to obtain funds for their expansion, while bonds are securities that can be issued by the state, companies, and other entities to raise funds. To understand more about what a share is, I will give a simple example. Let's imagine that I am the owner of a business which is worth $10. My business is two ice cream shops, the price of each is $5, and it brings me $2 a year. I dream of expanding my business, but I don't have money for that, and I don't want to take a bank loan and pay interest. I have the opportunity to issue my shares on the stock market where people can buy them to give me money. This process has the short name IPO, and as you already understand, it is needed in order to receive money in exchange for part of the business. To get a more detailed explanation of this, I will show you the difference between what happened and what we received after the IPO. Before the IPO, our business was worth $10 and brought us $2 a year, and we owned 100% of our business. After selling a portion of our business, we received funds to purchase a third ice cream shop, which also generates $1 in profit. As a result, our business is now valued at $15, generating $3 annually. However, we now only own 50% of it. You might ask me, why is this happening? The owner used to receive $2 per year, and now he receives 50 cents less, plus 50% of the business is transferring to others. The thing is, it's a bit more complex than it seems. Let's break it down. Again, our business makes us $3 a year and has 10 shares. This means that one share which costs $1 generates 30 cents annually. A little bit of math, and as a result we get a 30% annual return. Not bad, right? Now, imagine someone who puts money in a bank at 2% per year meets one of our company's shareholders. He offers to buy the shareholder shares for $3 each, because he expects to make a 10% return annually, which is much better than the 2% offered by the bank. If we use this example and sell 10 shares at $3 each, we will end up with $30. Congratulations! The owner who had 50% of all shares now has $15 instead of 10, which is a 50% profit. The shareholders who bought shares at $1 have tripled their money. They can also reinvest the profit and after 2 years buy one more ice cream shop, which will lead to a 25% increase in their profits, which will eventually lead to a further increase in the price of this business. Think of this as a basic explanation of how the stock market operates. Have you ever dreamed of opening your own bank and receiving funds by lending money to someone at a certain interest rate? If so, congratulations, you have that opportunity if you buy bonds. In simple words, a bond is a type of securities that represent a loan. No, you won't take out a loan. It's roughly when you lend money at a certain percentage to make profit. Have you ever wondered how banks make money? If you think that a bank takes money from people who put their money in deposits, and then the bank lends that money to other people, congratulations, you are correct. But that is only part of their profit. Another part of their profit is bonds. For example, what should the bank do if it didn't find anyone willing to take a loan? Correctly, they will buy bonds. If the bank buys a bond for $1,000 at a 5% annual return, it will receive $1,050 at the end of the year and pay $1,020 for a person's deposit and keep $30 in profit. That's how easy it's for them to make money from you, because the bank's deposit rate will always be lower than the yield on government bonds. I seem to have strayed a little from the topic of what is a bond in the end. Let's imagine a simple situation when the state does not have money to pay social security to its citizens. What should they do in such a case? They can choose to not pay money, I think you won't like it, or they can take a loan, called a bond. So, it's that simple. You give a loan to the state for its needs, and as a result, you will return your funds and receive a reward for lending your money to the state. In our example with the bank, it's 5% per year. In this short video, I describe topics such as stocks and bonds. I hope now you have a better understanding of them and have learned how the stock market and bond market work, and how rich people become even richer. If I helped to solve your question, please support me by subscribing to my channel.